Wall Street to Main Street to help small business owners have the same capital as corporate America and give them the same resources as a larger company. We cover business funding, business credit, scaling, business consulting, and much more. Check out the website at shieldadvisorygroup.com. Welcome to the show, The Liquid Lunch Project.
Hey, what's up, everybody? Welcome back to another episode of the Liquid Lunch Project. I am Matthew R. Meehan alongside my partner, the Professor Luigi Rosabianca. What's on tap today, Lou?
Matt, what's better in the dog days of summer than learning on how to invest and redeploy that capital? You know, there comes a time in a lifetime of a small business owner where he or she starts to make some money. And it would be nice to try to deploy that capital strategically, cautiously, maybe even conservatively, to develop that second, third, maybe even fourth stream of income. You know, we always love talking about cash flow and dividends. So to walk us through the process, founder and CEO of SublimeTrading.io, Zaheer Anwari. Welcome to the podcast, Zaheer.
Thanks, guys. Really excited to be here and looking forward to chatting with you.
How's the weather in London? Is that reputation correct?
Oh, let's not even go there. It's just suddenly disappeared. But, you know, we had a good run for about a month. But July, I'd rather not talk about it. I'm glad August is here. Let's see what happens.
So here, walk us through some of your finer points of investing strategies, please.
Yeah, so in general terms, I'm what you would call a trend follower. I look for the big moves in the markets. I'm a big believer in staying true to the sound principles of good investing. You know, you go online now, everything's about day trading and short-term trading and quick riches. I really sort of steer people away from that. Take advantage of the technology that we have available today and combine that with old school investment techniques. And it's a powerful, powerful combination. So that's really where my speciality lies, trend following and this sort of sweet spot of 12 to 18 months. That's my holding period.
So here, how do you accommodate those beliefs and strategies with having a diverse set of clientele? Like take Matt and I, for instance.
Yeah.
I'm boring as they come. All I want to see is traditional blue chip. You know, I like GE. I like 3M. I'm really, really boring. I mean, Matt sees my portfolio and he falls asleep and starts snoring. Matt, on the other hand, is a lot more innovative, maybe a little bit less conservative. So how do you conform your platform to the client's just inner needs?
Yeah, that's a really interesting question, actually. I think when people come to us, one of the main challenges that they face is consistency. Regardless of what you're investing in, consistency is the main challenge. So what we do is I sit down and I reverse engineer the process. That's the starting point. So I say to people, look, what have you got? Let's say $20,000. That's a savings pot that you're starting with. What do you want to achieve? Well, $1 million is a nice amount by retirement. Okay, that's great. Well, how long is that going to take you? Well, let's say 20 years. All right. So to reverse engineer that process, you're looking at about 19.78% annually. So now that you know that percentage value, you can now reverse engineer that process and you can look at the different investment opportunities and figure out the ones that are going to help you achieve your returns. And that could be, blue chip companies. It could be something more exciting, or it could be a combination of both. So I think it's when people reverse engineer the process, they then start deciding on what is the right thing to invest in as opposed to what I want to invest in. And I think that's a really important switch in mindset.
So are you working on more fundamental or technical analysis when you're looking at equities?
100% technical analysis. Okay. So I take the stance that fundamentals is perfectly suited for institutions. They pay a lot of money to get news early. They pay for things like Bloomberg terminals and Thomson Reuters terminals. So they get news even seconds before it reaches us, the retail investor. So technical analysis is really powerful in that sense, because what I can do is I can look at where the institutions are positioned. I can look for the big moves in the market. I can then position myself and piggyback the ride. So it's far easier to just use technical analysis.
Yeah, I'm a big believer in technical analysis. So when I'm running trades, but I use a combination of both fundamental and technical analysis. I'm a big believer in following Bill O'Neill's theories. IBD, Investors Business Daily, and also who are some traders that you followed? Because Jesse Livermore was one of my favorites from the past.
Absolutely. Yeah, absolutely. Look, this is the way I would look at the combination of technicals and fundamentals. I would say if people do want to look at fundamentals, that's all well and good. But look at the technicals first and then find the fundamentals that back up the technicals, rather than look at the fundamentals and then use technicals to back up the fundamentals. If you switch it the other way around, because you're focusing on price action, and that's the most important indicator, you'll then have the fundamentals that back that up. So I think that's what I would suggest.
Oh, no, I totally agree with you.
Yeah.
The first thing I'll do is I'll look at a chart and see if I like the chart, see if it's forming a cup and handle or basing out, making a next leg up, right? But we all love making money. Talk to me more about how you help your investors protect their money and watch their downside risk.
Yeah, good. So first and foremost, investing is all about having an edge. You've got to have an edge. That's the primary foundation of taking an investment decision. So an edge is ultimately defining environments where you have more chance of making profit than a loss. So if you can start stacking the odds in your favor from the moment you can identify an edge, everything else falls into place. So first of all, have a proven edge. There's a saying that if you cannot define your edge, you don't have one. And if you don't have an edge, you will get eaten by someone who does. So we have an edge, right? Once we've got an edge, we're still playing on probabilities. This is the important thing. It's not a guarantee, it's still probability. So once you've got that understanding, that's where risk management comes in. Typically, we don't risk more than 1 to 2% per position.
Interesting.
And then
that's
we
really
ensure that every position has a stop loss. So the stop loss is unique to the asset's volatility. We use a formula based on ATR, average true range, and we then take a multiplier, multiply it by 4 or multiply it by 5. And so every asset, first of all, has an edge, has a low risk, and has a stop loss.
Yeah, 1 to 2% is extremely tight, but it's not about, you can take small losses. You can't take multiple big losses, right? When you take a loss, it puts you right back in the game. Technically, what I do and what I used to do for my clients was with a simple philosophy: stocks go up and stocks go down.
Yeah.
Right. So what we would do is we would trail a stop loss about 8% below the company's trading level. And every time it ran up to a new level, what we would do is just trail that stop loss up. So let's say the stock moved up 10%, our stop loss moves up, we get stopped out, we still make 2, we're still in the game to move forward next day.
Yeah, simple, exactly. And something you can add to that, and something that we do here, is that we add to our winning positions. So we risk 1%. As you said, keep your losses small, cut out of losers, hold your winners and let them run. But importantly, compound your winning positions. So I just keep on adding more 1% positions strategically along a winning trend. And so that what that will do is that will exponentially grow the upside, but my downside is always capped at that 1% to 2% loss.
We used to have a saying back on Wall Street. Most people say buy low, sell high. We say buy high, sell higher. Because when you have the momentum in the stock, that's where all the money and the volume's running into it, right? So there's no reason this. Sorry about that, guys.
No
Alexa.
worries.
But yeah, when the momentum's there, it's there. I mean, listen, we saw the craziness that went on with COVID, right? You had more people introduced to the stock market through Robinhood and these other game-like apps out there, and there was money flowing around. That's why the market took off the way it did, right? It's just supply and demand. There was a hell of a demand out there.
Spot on. And just to go back to what you say, very rarely do I hear people say what you say, which is buy high, sell higher. Everyone is obsessed with this philosophy of buy low, sell high, because that's what's been drummed into us. You've got people like Warren Buffett, who've obviously done very well with value investing, and they assume that value investing is really the only approach to making money in stocks. It is. And you look at performance tables. Richard Dennis, the founder of the Turtle Trader experiment in the 1980s, he topped performance tables. He was a trend follower, buy high, sell higher. Same with Jesse Livermore, trend follower. So I'm really glad that you said that, Matt.
So talk to me. How did you get started in trading? What was your background prior to it?
So I've actually got a degree in software engineering. I worked for a year during my university time. I did a sandwich course. I worked for a year for Oracle, Larry Ellison's Oracle here in the UK. And I quickly realized I had no interest in that. So I then traveled.
Here, do you realize that you are a unicorn? You're actually a software guy that likes to make money? Who are you?
Well, you'll be surprised. You'll be surprised. One of the analysts that worked at one of my company, he was literally a rocket scientist. He worked for NASA and decided he didn't want to do that anymore. And then he just, he liked numbers, and he became one of the top analysts in the country.
I think when you grow up in a place like London, it's a place of opportunity, but it's also extremely expensive. Yeah. So you've got to have money coming in, So you can, even with something, let's say £100,000, which may be, I don't know, 140,000 US dollars, you can have a decent life in London, but you can forget the finer things in life. If you want the finer things in life, you've got to invest and you've got to compound. So you've got to save your money, you've got to invest your money, you've got to compound your money, and you've got to give it time. So once I started understanding that process, for me, it was just about making as much money as I could in my 20s. And that's what I did. I was working 7 days a week often and just saved it, invested it.
Did you go and self-teach yourself how to do this? Did you learn from somebody else? Did you work on any investment banks?
No, never worked in the city. So never worked for a hedge fund. I've had various mentors over the years. Some were good, some were bad. Day trading mentors, swing, trend following, the whole shebang. I basically gravitated toward trend following because it was less work and more money. And then I just went about perfecting the process, perfecting the strategy, creating the toolkit, the software that I have developed, the tools. And it's been a bit of a journey, but a bit self-taught, but also, what I learned from other people, got rid of what didn't work and just made what worked better.
Now, are you day trading 24/7 in front of your computer? Are you trading the U.S. markets? Are you trading the U.K. markets? What are you doing?
So I don't day trade. So I take end of day positions. So once the market closes, so the US market closes, which is 9:30 UK time, generally 9:30 p.m. UK time. That's when I get my scanners. I use Metastock, again, US company. Use Metastock, scan the UK market, the US market, commodities and currencies. I'll go from, say, 20,000 potential assets down to an initial list of 200-300 assets. I take those 200-300 assets, put them through my technical analysis screener, manually go through them, and then the 5 to 10 assets that come out of that screening and scanning process, that's ultimately what make into my portfolio. Place my positions, close my computer, repeat at the end of each day. So I don't have anything to do with the intraday activity.
No, I love that you watch technical analysis, because I hate when people tell me, well, I think it's going to, doesn't matter what you think. The stock's going to do what it wants, right? Nobody knows anything at the end of the day. We can only trade what we see.
Spot on. So, ignoring opinions is one of the first rules of investing, and that's yours. You go into LinkedIn and it's just that, it's a mosh pit of noise. People calling tops, people telling you what's happening. One day they're short, one day they're long. And the whole time you're buying into that. You're just missing this trend. The S&P's been moved up 30% since October of last year. People just standing aside watching that happen. So follow the market, follow the charts. That's where the truth is.
So here I want to be focused on our audience as well. Obviously we're all small, medium-sized business owners here. Matt and I preach to our clients all day long: make money, bootstrap, minimize your losses, bootstrap, make your money, try to minimize that debt service. How do you compromise that logic and that consistency with investing in public companies where the trendiest aren't making money?
Yeah, it's a good question. Again, I mean, look, when I went back, I can only really sort of talk about what I did, and I hope that can sort of resonate with people. When, of course, in the early days, I had my university debts, etc., that I had to sort of take into consideration, but I didn't really pay too much attention to that. As long as I had the minimum amount being covered and I had my lifestyle well looked after, any extra cash flow that I had all got saved. So I really recommend that's what people should do. I know there's this big sort of agenda or movement out there to say, hey, clear off your debts first, clear off your debts first. Well, it could take you 20 years to clear off your debts.
That's so un-American, Zaheer. I mean, we're a consumer population. All we do is buy.
Yeah. Well, I mean, it's very, the way I think it's probably not very British either as well, because it's the same thing here.
See, I'll take the opposite side of that. And if we were 2 years ago, I'd say, give me as much debt as you could possibly give me, at 2 to 3%, so I can go invest the money somewhere else and make 5 to 6 to 10 to 12 to 30.
Yeah, absolutely. And why not? And why not? As long as you have the cash coming in to manage your debts, that's the important thing. Generally, people take on debt and then that just spirals out of control. And they usually experience compound growth going against them. I don't know what it's like in the US, but here in the UK, we can get, for example, credit cards that are interest free for 4 years, for example. So, some software, for example, Metastock, could cost me $2,000 or $3,000 when I'm first starting up. Okay, go get an interest-free credit card, put it on there, pay the minimum off, grow whatever wealth I've got to a point where just I can clear off that credit card in 4 years. So there's little clever things that you can do, but I would say the most important thing is being in a position to cover your minimum debts, but save, and then transfer that into investments.
So Lou, I want to touch on that for a second because like you said, we tell our clients, you got to keep trying new things. The minute you stop trying is the minute you start dying, right?
Yeah.
But also what most people have to realize, and this goes back to what Zaheer said about trading, right? You need to keep trying stuff, but when you notice something doesn't work out, you need to cut your losses fast. But here's the key. You need to compound and pour gasoline on your winners.
100%.
So let's say you're constantly marketing. It's just like trading. I'm trying this marketing strategy. I'm trying this strategy. I'm trying this strategy. 2 strategies fail. The other one is starting to go. What you do is just like you'll add to a stock position, you'll add more capital to that marketing strategy to push it further along.
Exactly. If people think in terms of how large their winners are, as opposed to how many winners they have, it will completely revolutionize how you manage your portfolio. So a question that people often ask me is, what's your win rate? And I could say to them, well, I only have a 30% win rate. And they'll be, you must be a crap investor. But they don't realize that my 30% win rate generates me 7-8 figures a year, right? Whereas I could have a 90% success rate, but that 10% blew my account. So it's not about how many winners you have. Focus on how large your winners are. And as you said, keep on compounding.
Well, that's the whole venture capital philosophy, right? I'm going to invest large amounts of money into 10 companies. 7 are going to fail. One's going to do okay, and 2 are going to take off. And
Absolutely.
that 100 million I invested, yeah, don't worry about it. I lost, 700. What is 700,000 or whatever it is, 700 million, whatever the numbers are, right? On those, but the other 2 became $2 billion companies.
Yeah, perfect.
Well, gentlemen, if you guide yourself accordingly, you only have to get rich once.
Absolutely.
Well, what's funny about that is I've heard people getting rich once, losing it all again. But then you know what's funny? They come back and they make more than they've had before in the past.
Jesse Livermore's a good example of that, right?
Jesse Livermore, for everybody that don't know who he was a trader back in the late 1800s, early 1900s, right? So Jesse Livermore, he would go broke all the time. He'd be really wealthy and go broke. But every time he was wealthy, he'd go out and he'd buy his wife jewelry. She'd have the best diamond necklaces, the best, Tiffany earrings, this and that. And when he went broke, you know what he did? Hey, honey, I need that jewelry. And he went and sold them or brought them to a pawn shop to get a loan to get back in the game again.
Absolutely. I mean, it took its toll in the end. I wouldn't recommend what Jesse Livermore did throughout his career. You get rich once, keep it, protect your money like you protect your kids, like you protect your future, like you protect your dreams. It's important. It doesn't have to be, this up and down yo-yo style of journey. Be smart, be consistent. Over 5 to 10 years, you'll generate substantial amount of money, and more importantly, you'll perfect a set of skills that you can pass on to your kids and your loved ones, because the schooling system isn't going to do that for us. Doesn't do it here. I'm sure it doesn't do it in the US. So who's going to teach your kids? So, that sort of idea of generational wealth, it has to be more than a buzzword.
I'm so glad you said that, because I was just away. I guess you would call it. I was on holiday for a month, and I had my kids with me. They're 2 little girls. They're 9 and 11.
Oh, nice.
We had a whole week's worth of learning, right? They learned about real estate, why we invest in real estate,
Brilliant.
why we invest in stocks, right?
Brilliant.
They already had their own portfolios going. So I gave them a test, and if they passed their test, I'm giving them $1,000 each to invest in with stocks.
Lovely, Matt. Yeah. Perfect. Yeah, really good. I mean, if I had my own kids, I don't have kids, but if I did, I would. My sister's got 3 of them. So, I'm always encouraging her to instill that idea of saving money. And, talking to me about investing it. So yeah, good on you, Matt.
Yeah, I mean, look, for me personally, I didn't know what a stock was until I landed a job on Wall Street. When I asked them, they told me it's something that blinks red or green on your screen. Get on the phone and start cold calling.
Yeah, Lou, you have kids?
I do. I have a baby boy.
Oh, so you're a young, you're a new dad.
A new dad. Yep.
Fantastic, excellent, congratulations.
Thanks.
So are you taking long positions only? Do you do short positions? Do you do option plays? Are you in any other markets like Forex or crypto?
Yeah, great question. Thank you. So I am generally always long on the stock market because the stock market generally goes up. The last time I took short positions was back in 2008 when we had the big crash, the financial meltdown of 2008. But I started investing, trend following, if you like, in 2007. So one of the first things people assume is that I lost a lot of money the year after. But what they didn't realize is that I learned to look at charts. I learned what the 200 simple moving average represented. So above it's a bull market, below it's a bear market. We have broker accounts that people aren't aware of that you can take long and short positions. Traditionally, you just have traditional bank accounts are just a buy only. So, the technology's changed. The marketplace is different now. So if you learn to leverage that, you can position yourself correctly. But since 2009, I've just been long on US stocks. Even, for example, last year in the S&P 500, it tanked 28%, right? But healthcare and energy went through the roof as sectors. So you have stocks like McKesson Corporation, ticker symbol MCK, that moved up 60% when the S&P 500 fell 28%. So, there's always stocks going up, even when the indices are correcting.
No, you're absolutely right. I think one of the problems, though, technology's changed. I left advising and trading in 2015, and things changed, right? Yeah. Somewhere between 2012 and 2015, you started to have all these gurus pop up on the internet, telling you how they're making millions. It was the penny stock letters of the 1990s that moved into the social media age.
Yeah,
right? And they're still out there. And some of these guys, just because you had a couple winning trades. Talk to me about your losers before you talk to me about your winners, right? How did you manage them on the way down? Because that's what most people care about. Because we're going to have wins, but we're also going to have losses. And it's a matter of how you handle those losses.
Absolutely. A little tip that I would ask people, if they want to get involved, if they're looking for an educator or a mentor, ask them for a complete track record on a live account over at least 1 to 2 to 5 years. Not back tested, not a 2-week window of winning trades. Ask for a whole history, a complete history. Because if they're educators, they're experts. And if they're experts, they've got a track record. And they've got to have a track record of a very minimum 12 months, ideally 2 to 3 years. And if they can't display that, you know who you're dealing with. You're dealing with a fugazi, right? So understand the person you're talking to.
Zaheer, let's take your opinion, being on the other side of the pond. What's the vibe outside of the U.S. with Fitch's recent downgrading of U.S.?
Look, whatever's happening on the other side of the pond, I think people here in the UK are always confused about. It just adds more to the mayhem that we hear about on our media channels. When people ask me what I think about what's happening, opposed to what is actually happening, particularly when it comes to my investing, I always go back to what Matt has said, which is what is happening in the charts. What is the charts doing? Things are being downgraded. Things are happening. There's elections going on. Trump's going through whatever he's going through. Ukraine is happening. There's all sorts of stuff happening. Yet the S&P 500 has managed to work its way up by 30% in that time. So from an investment point of view, I say keep just looking at the charts. It's as simple. Keep it simple. Good investors are good kissers. Keep it simple, sweetheart. I know that as the last S is meant to be something else, but I like to use the sweetheart word.
I never heard it put that way before. I like it. I think I'm going to start using it. So Zaheer, tell us about your academy and how you've made it simpler for normal, everyday people who are intimidated a little bit in the market to get their feet wet.
Yeah, thank you. So, look, by the time people come to us, particularly men, they've often lost a lot of money. The difference between men and women is this: women are very process driven, hold a lot in cash. Men see the money and will do anything it takes to make the money. So generally, it's a very male dominated space. There's more women getting involved, which is good to hear, but generally it's very male dominated. So by the time men come to me, they're often paid a lot out in courses that have overpromised and underdelivered, portfolios and performing, lost a lot of money, generally along those lines. Of course, that's not everyone. There's some people who've done very, very well. They just want to do better. So what we do is start with their portfolio, look at what they're doing, look at what it's achieved or what it hasn't achieved. And then we start introducing the processes that work. Teach them about technical analysis. First of all, teach them about trend following. Step 1. Step 2, show them what a good stock is. Using scanners, using charts, understanding and identifying what an edge looks like, a repeatable edge. Very simple. I mean, my community members now can look at a chart and tell you within 5 seconds whether it's investable or not. If you find yourself staring at a chart, you're looking for something. And often what you're looking for is a reason to invest something based on some kind of attachment. Hey, I love Tesla. Let me find a reason to invest it. So you want to get rid of that. Be very objective. So we show them what a good edge is and what a stock is. And then we transfer that into how to manage a broker account. Keep it very, very simple.
So where do you see your trading and your academy moving to in the next few years? Do you think you're going to go out and you're going to manage money for people, or are you just going to continue to teaching them to trade their own?
Thank you. Again, great question. As of earlier, well, actually, we're in August now. Jesus, can you believe that? We're in August. Last month, I had my hedge fund now officially set up. So I have a hedge fund officially set up in Luxembourg, which is, it's fantastic because we can onboard people from the US. I did have a locally based hedge fund here in the UK, but because it was leveraged, we weren't allowed to onboard US clients because due to your leverage regulations and retail regulations. But a lot of attention for a hedge fund came from US residents. So I was like, okay, look, I need to sort this out. So I've now managed to set my hedge fund up in Luxembourg. So as of last month, we're now in the money management game. So we've got that side of things. Ultimately, people fall into 2 categories, right? They either want to learn or they don't want to learn. But what they do have in common is that they want better returns than they're already getting. So when they come to us, they say, well, I say, what do you want? Do you want to learn or not learn? Okay, I want to learn. Fine. That's where the education comes in. You don't want to learn? No problem. Let's talk about fund management. So that's where we're going now. We've got something for everyone.
That's fantastic. Zaheer, we definitely appreciate you being here. You definitely give a lot of value to the audience. Why don't you tell the audience members where they can find you on social media, your website for your academy?
Yeah, brilliant. Thank you. So just head over to sublimetrading.io. That's where you'll find all the information about our academies. And if you're on LinkedIn, guys, I'm pretty active on LinkedIn. I'm building a bit of a reputation for myself as being a thorn in the side of what's going on there. Because hey, look, everyone's short and I'm long, and the S&P 500 is only going up. So someone's got to be right. So please connect with me on LinkedIn as well. I'd love to. Zaheer Anwari. Just search for my name.
Zaheer, thank you so much, my man. But one question before I do let you run.
Yes, please.
What's the best trade you've ever made?
That's a difficult one. I would say Nvidia, when it first came to light back in 2016, I believe it was, when it was around $40, and Nvidia started really kicking off. And then obviously Nvidia's gone through a split since. But I held positions in Nvidia all the way up to, I think it was $800 when it went through its split. So Nvidia's been very, very profitable stock for me over the years.
Yeah, I traded in Nvidia a lot throughout the years, but I mean, this seems to be their year. Everybody's talking about them.
I mean, it's a top performer, but a little tip to people out there: the true money, the real wealth, is in stocks that gets no media attention. Because if those stocks were in the media, everyone would be rich. So that's my little tip to everyone. Do not focus on what's in the media. Focus on what they aren't telling you. And that's really where the money is.
Zaheer, thank you so much for being here. Everybody, that's a wrap of the Liquid Lunch Project. We'll catch you on the next episode.
Thank you. Appreciate it.
Thank you for listening to the show. And make sure you subscribe, leave a review, and share it with a friend. We'll see you on the next episode of the Liquid Lunch Project.